Hello friends. So friends, we are going to continue with ratio analysis, and this is going to be the last lecture for ratio analysis, right? So we were discussing about the last set of ratios, that is profitability ratios, right? This is what we were discussing. Profitability ratios, we discussed 4 ratios so far. The first was gross profit ratio. Second one, operating ratio. Third, operating profit ratio, right? And the fourth one, net profit ratio. And what is the main aim of ratio analysis? What is the main aim of profitability ratios? The main aim is to identify that whether we are using the various resources of the business efficiently or not, and thereby whether we are earning sufficient profits or not, because the aim of any business is to earn sufficient profits, right? So this is what we have been discussing in the gross profit ratio, in the operating ratio, in the operating profit ratio, and then in the net profit ratio, right? These ratios are always expressed as percentage. Clear? Now, in this lecture, we are going to start with the final ratio under the profitability ratios, that is return on investment or return on capital employed ratio, right? This ratio is known as either return on investment ratio or return on capital employed ratio. Now the first thing that we will identify is the financial factors between which we have to establish the relationship. Simple. First of all, I will tell you the two financial factors between which we have to establish the relationship. So the first factor under this ratio is net profit before tax and interest, right? And the second point is capital employed. The second point is capital employed. So if we talk about return on capital employed ratio, the two financial factors we have to consider are, the number one is net profit before taxes and interest, and the second one is capital employed. Clear? Now what is capital employed? We'll discuss capital employed first. Net profit before tax and interest, you all know, right? In the previous lectures also, we discussed about the net profit after tax and interest, isn't it? When I prepared the trading and profit and loss account, just go through the last lecture first, right? Go through the previous lecture of ratio analysis. There I discussed the net profit after tax and interest. Here we are saying net profits before tax and interest. Clear? So it is not a big issue, right? So we'll discuss about the capital employed. Now what is capital employed? In a very simple terms, if I say what is capital employed? Capital employed is the money invested in business. Your money invested in business is capital employed, right? And what is the purpose of calculating this return on capital employed ratio? What do you mean by this return on capital employed ratio? Right? capital employed is money invested in the business, right? So through this ratio, you try to identify that how much money is invested in the business, right? And by investing that money, how much net profit we are earning. By investing, suppose you invested 100 rupees in the business and you are earning a profit of 500 rupees, right? This is what we have to find out. This is your capital employed, right? You invested 100 rupees in your business, and by investing 100 rupees, what is the return that you are getting? What is the profit that you are earning from that business? The profit is 500 rupees. This is net profit. Before taxes and interest means before paying any statutory requirements. Before meeting any statutory requirements, overall what you are earning. Clear? So capital employed is the money invested in the business. How much money you have invested in the business. Very simple. Clear? And by investing that money, how much profit you are earning. This ratio explains us that by investing 100 rupees, you are earning a profit of 500 rupees. Right? So this ratio tells us the relationship between these two factors, that by investing how much money you are earning how much profit. Clear? So now if we talk in the accounting terms, how to calculate this capital employed? How to calculate this capital employed? See, there are two approaches. If we talk from the accounting point of view, there are two approaches. The first one is liability approach, right? The other one is asset approach. What is liability approach? It says shareholders' funds. If you are the shareholder, that means you have invested money in the business. That's why you became the shareholder. You have bought the shares of the company. You have become the owner of the company. You have invested the money into the company. That is why I say shareholders' funds. Clear? The second thing that I will consider is reserves and surplus. Although it is a part of the shareholders' fund only, reserves and surplus plus share capital. This consists of shareholders' fund. Right? Reserves and surplus means the profits that you are earning that belong to you. Those profits you will invest in the business for future. Right? Clear? So the first thing that I consider is shareholders' fund under the liability approach, and I will add non-current liabilities in this. Non-current liabilities like long-term loans, right? Debentures. Why not short-term liabilities? Because the short-term liabilities will be paid off within a period of 12 months, right? But profitability will be viewing from a long-term angle. So what we are considering, if we are investing in the business, we will invest it for the long term, not short term. Clear? So under the liability approach, we have shareholders' funds that consist of reserves and surplus plus share capital. Then we have the non-current liabilities. Now what about the asset approach? Under the asset approach, we'll have non-current assets. Non-current assets plus current assets, right, minus current liabilities. This consists of working capital, that is the excess money that we have. This excess money will be invested in the business for future. That's why I am taking the working capital, that is the excess of current assets over current liabilities. Clear? So for the capital employed, there are two approaches. The first one is liability approach. Liability approach consists of shareholders' funds, that is the amount that you have invested. You have bought the shares of the company. For buying the shares, you have paid company some money, that is investment in the company. Non-current liabilities, which are long-term liabilities, long-term borrowings. You borrowed the money from the bank, you invested that money in the business, that is what? A non-current liability. Clear? What about the asset approach? Non-current assets, those long-term assets, right? Plus the working capital. That means the excess of current assets over current liabilities. Because that working capital will be invested in the business for future. Isn't it? The working capital will be invested in the business for future transactions. That's why we are considering working capital. Clear? So, now net profit before tax and interest, you all be very clear about it, right? Nothing much to explain in this. Capital employed, I have explained, it is the money invested in the business. And how much profit you are earning by investing that money, that is the main purpose of this ratio. So how to express this ratio? This ratio is expressed as return on investment ratio is equal to net profit before taxes and interest divided by capital employed multiplied by 100, because the profitability ratios are expressed in percentage. Clear? Clear, friends? So higher the net profit, the better it is. Therefore, higher the ratio. Higher the ratio means higher return on your capital employed. Higher the ratio, better it is. Clear? So this is your return on investment or return on capital employed ratio. Net profit before taxes and interest divided by capital employed. So let's do a practical problem on this. Right. From the following information, calculate return on capital employed or investment. We are given net profit after interest and tax 1,20,000. We are given tax as 1,20,000. Net fixed assets of 5 lakhs. Long-term trade investments 50,000. Current assets 2,20,000. Equity share capital 50,000. Preference share capital 50,000. Reserves and surplus 1 lakh. Current liabilities 1,70,000 and 12% debentures of 4 lakhs. Now, first of all, we'll calculate the net profit. We'll calculate net profit before interest and tax. What we are given? We are given net profit after tax and interest. After subtracting tax and interest, we are given a net profit of 1,20,000. So we have to add back two elements. One is tax, the other one is interest. Tax we are given as 1,20,000. We are given net profits after interest and tax 1,20,000. Tax is 1,20,000. Now, where is interest? Interest is to be paid on debentures. How much? 12% of 4 lakhs. Interest on debentures 12% of 4 lakh. This comes to 48,000. So the total net profit before interest and tax comes to 2,88,000. This is your net profit before tax and interest. Clear? So you have the first element covered. Now we'll calculate the second element, that is capital employed. Right? Capital employed, we have two approaches. We have liability approach and we have the asset approach. Now, net profit before interest and tax we have covered. Net fixed assets of 5 lakhs. This will come under which approach? Fixed assets. Here, fixed assets of 5 lakh. Right? Long-term trade investments of 50,000. This will again come under asset approach. Investment of 50,000. Next, current assets of 2,20,000. Again, this will come under asset approach. Current assets of 2,20,000. Next, equity share capital of 50,000 and preference share capital of 50,000. This will come under liability approach. Just remember the balance sheet format that you have been preparing. Right? Here you have equity share capital of 50,000. Then you have preference share capital of 50,000. Clear? Next, reserves and surplus 1 lakh. This is again a part of liability approach because it is the profits. Reserves and surplus. How much? 1 lakh. Then you have current liabilities of 1,60,000. What to do with the current liabilities? You have to subtract current liabilities of 1,70,000. Clear? Then you have 12% debentures. This is your long-term borrowing of 4 lakhs. So this comes to 6 lakhs. And if you will total this, this will also come to 6 lakhs. So we have calculated capital employed from both the sides, from the liability approach also and from the asset approach also. And in the exam also you can show both the approaches. If you have the sufficient information regarding both the approaches, you must show both the approaches. Right? Because that shows your understanding of the concept regarding the capital employed. You must show both the approaches. Clear? Now you have got net profit before tax and interest, and you have got what? Capital employed. Right? So now you can calculate the ratio. Return on investment is equal to net profit before interest and tax divided by capital employed multiplied by 100. What is the net profit before interest and tax? 2,88,000. What is capital employed? 6 lakhs multiplied by 100. So this comes to 48%. That means out of the total money that you have invested 6 lakhs, out of 6 lakhs, 48% you are earning net profit. By investing 6 lakhs, You are earning a net profit of 2,88,000. Simple. Clear? Clear about the return on investment or return on capital employed ratio. Clear, friends? And in the examination, if you have sufficient information regarding the capital employed, you must show both the approaches. That is the liability approach also and the asset approach also. You must show. Right? So friends, that's all with the ratio analysis. Right? If you have any queries regarding any chapter, any accounting term, any question, you can send me an email at ksjteaching@gmail.com. If you have any queries, if you are unable to solve any questions, just send me the image of the question. I will definitely send you the solution to that question along with the explanation. Right? Any kind of queries, just send me an email at ksjteaching@gmail.com. I'll try to answer your queries as soon as possible. So that's all for this lecture, friends. Thank you so much.